SoFi's stock price is up 50% for the year, reminding some investors of when their stock price temporarily shot to the moon when they went public via Chamath Palihapitiya's SPAC merger. But there's a ton of debate online right now between the bears and the bulls on this fintech company. Is SoFi out of the $5 per share slump that they've been stuck in for months and about to 5x back to its former stock price of $25 a share? Or is this just a dead cat bounce for a company that is ultimately going to go bankrupt? I know that those sound like two extreme options, but in this video, I'll be looking at the main arguments for why people think SoFi could go bankrupt and whether they'll have a chance to prove the company's value to investors or if they'll run out of money first. So let's dive right in and find out. So SoFi started out originally as a student loan company at Stanford back in 2011. This is important to know because we can only tell where SoFi is going next by seeing where they've already been. They operated for years, mainly offering private student loans across the country. But after some reshuffles in leadership, after a few high-profile scandals, they emerged into the 2020s as a very different company. Just to give you a super quick summary of SoFi today, they are really three businesses in one. You have lending, where they make a lot of their profit. You have financial services like SoFi Invest, their checking and savings account, and their credit card. These are like SoFi's top of sales funnel where they attract new customers before funneling them into more valuable areas of the company like lending, for example. And you have their technology platform, the tech backbone that runs all their services and that SoFi is now selling to run other fintech companies' businesses. Robinhood is an example of a company that runs on SoFi's platform, but SoFi has ambitions to expand beyond where they are today. And this also affects how SoFi is valued. They seem to have the volatility of a tech stock, but at least right now, they're getting the low valuation of a bank. And the biggest reason for this valuation is the fear that SoFi could go bankrupt. Obviously, SoFi has massive potential to become more valuable. They're growing their revenue at 52% per year, meaning they would 5x in size over the next 4 years. And they are doing a great job of attracting young customers who will only be making more and more money as they get older. And yet their stock price puts the company at a market cap of around $7 billion today. If you compare this to their book value of $5.17 billion, which basically represents what SoFi would be worth if it were torn up and sold off for parts, you can see that the market doesn't seem to think that that future growth is going to happen. But why is that? With sky-high stock-based compensation, the company burning through their free cash flow like crazy, and more articles popping up warning of a pending bankruptcy, it's no wonder people are nervous. But let's take a deeper look into those worries, because if SoFi is going bankrupt, we want to get out of the stock now. But if it's not, it could represent a huge opportunity to make 2, 3, even 4x returns over the next few years. But speaking of looking deeper, have you ever Googled yourself to see what information comes up? Like, you search your name and you get these results that have a creepily large amount of private information about you. Well, this information is accessible because data brokers profit by selling your information to robocallers, telemarketers, spammers, and pretty much anyone that wants to learn more about you. And that's why I'm excited to tell you about today's sponsor, Aura. Aura will identify data brokers that are exposing your information and automatically submit opt-out requests on your behalf. They'll even opt you out of junk mail and telemarketing lists because it can be annoying and even dangerous if your information ends up in the wrong place. And you can use my link in the description to try 2 weeks for free and see just how many data brokers are sharing your information. Or you can scan the QR code on your screen. Aura also monitors your emails and passwords to see if they were exposed in a data breach and exposed on the dark web. Here are all the actual data brokers that I found had my personal data when I signed up with Aura. There ended up being more than 30 of them. Aura's app also features a VPN, a password manager, real-time credit and identity theft monitoring, internet parental controls, and protects your devices from malware, all inside one app. So let Aura do the hard work of keeping you safe online, and if you sign up right now, Aura will give you a 2-week free trial with my link in the description of this video. It is seriously crazy how much of your private information they can find exposed in just those 2 weeks. Go to aura.com/fintech to start your free trial now. That link is in the description, or you can just scan the QR code. And now let's get back to whether or not SoFi is going bankrupt. So one of the first search results that comes up when you Google SoFi bankruptcy is this site, Macro Access. They make what looks like auto-generated articles that discuss companies' earnings. In this article, they discuss SoFi's likelihood of bankruptcy and say SoFi has a 69% chance of financial distress. Now, they say this doesn't mean SoFi will go bankrupt, but they have a high chance of running into issues continuing to meet their financial obligations. And they calculated this probability based primarily on 2 metrics, the Altman Z-score and the Piotrowski F-score. I don't know why, I just feel like you have to say that with a Slav accent. Now, I don't like to take anything people write at face value, so I decided to look deeper into how these 2 different scores are calculated, especially if these are going to allow us to predict how likely SoFi is to go bankrupt. bankrupt. So the Altman Z-score was originally designed by NYU finance professor Edward Altman in 1967 for analyzing manufacturing companies. He found in a research study that it had an accuracy between 82 and 94% accuracy at predicting if a company would end up in financial distress. Many recent studies have even shown that the Altman Z-score correctly predicted the Great Recession of 2008 by just looking at the average Z-scores across the market. Now, the Altman Z-score uses this equation, which I'm not going to go through, but to oversimplify, it measures how much money you have and how quickly you're burning through that money. And I watched this entire 2-hour video of statistics just to give you that explanation. So if you appreciate the effort, maybe hit the subscribe button. Looking at SoFi, the Altman Z-score for this company is 0.6, indicating SoFi has a high likelihood of being in financial distress and potentially even going into bankruptcy in the near future. That's pretty horrifying if you're a SoFi investor who just now stumbled across this information. There's only one problem. Buried in those research papers and academic presentations I was going through, there were some warnings of the limitations of the Altman Z-score. First off, this metric does not work well with banks or other financial institutions. While Altman did design a version of this metric for banks, the Altman Z-score consistently gives banks much lower scores because their business model differs so radically from the manufacturing style companies this was designed for. Oh, and the other shortcoming is it tends to rank software companies lower than it should. So it's probably not a great metric to use with SoFi, a bank and a software company in one. But okay, that's not the only metric that this website used to calculate SoFi's risk of bankruptcy. Maybe the other metric can give us a more convincing argument. The Piotrowski F-score, which was created by a Chicago accounting professor, so I guess I can stop doing the accent. Well, they give a company a ranking between 0 to 9 in its financial position. 0 is considered the worst and 9 is considered the best. Now, this doesn't measure the likelihood of bankruptcy exactly, but it does give a look at whether or not the company is undervalued or overvalued. So if we look at MacroAccess's score for SoFi in this category, it looks like they gave them a score of 0? Well, that's pretty concerning considering this is one of the 2 main metrics that this website used to rate SoFi's likelihood of going bankrupt. So let's see why SoFi got such a low score. If we scroll down, we can see that they didn't actually have any of the data to calculate the score in the first place. None of it is available. So the website just defaulted to giving them a score of 0. So the Z-score isn't a good metric, and they didn't even calculate this metric correctly. And yet this is one of the top search results for SoFi bankruptcy on Google. This is really unfortunate because if you're just an investor trying to see if SoFi is risky, you could be fooled by a site like this. If anyone from MacroAccess is watching, you might want to fix this or add some more safeguards on which articles get automatically published, especially if you don't have the data available. But I don't want to use this site as a straw man for all the arguments against SoFi, because there are legitimate reasons that investors might be nervous about the company's future. So there are 2 other arguments that I think could be convincing with SoFi. And I'll just say here that some people might think the continued pause on student loans is a major issue for SoFi, but their lending business seems to be making plenty of money without it. So that's not a big worry for me. There are 2 bigger arguments that I think a reasonable investor could make for why SoFi's stock price will decline from here or even bring the company into bankruptcy. And the first is stock-based compensation and dilution. So there's been a lot of noise around SoFi's high stock-based compensation, where rather than paying employees and leadership directly, which would raise expenses, they instead issue them shares of stock that end up diluting the existing share price. SoFi's stock-based compensation was equal to around 26% of their revenue a year ago. In 2022, they issued an equivalent of $305 million in stock-based compensation alone, which means all that new stock is putting downward pressure on the current stock price. The argument against high stock-based compensation basically says, hey, the stock price is down, why are you paying your executives a ton of money at the expense of us shareholders? Which is a reasonable reaction when you're a frustrated investor who's lost money in the company. Plus, when you look at GAAP accounting, which I normally don't, but some investors do look at it, it could actually make the difference between SoFi appearing to be profitable and SoFi being unprofitable. But in my opinion, a lot of the hate on SoFi here is really driven by short-term thinking. There are 2 alternatives to high stock-based compensation. 1, you could pay people less, or 2, you could pay them in cash instead of in stock. Well, the whole worry with that second option is SoFi could go bankrupt, so you really don't want to be spending that kind of cash right now. This would also pull money out of the business itself to fund employees, which would limit SoFi's ability to grow quickly. I can't name a single tech company that doesn't offer some level of stock-based compensation, with many growth tech stocks paying as much as 40% of their revenue out as shares. shares. So I really don't think that paying only cash is a reasonable option. Now you could go somewhere in the middle where you pay some of it as cash and some of it as stock, but again, that's going to be pulling money out of the company that you need to operate. But then there's the other option, to just pay people less. One of the big things any leader knows is it's important to align incentives. If you want to make someone work hard, make them earn more the harder they work. And stock rewards do this particularly well because if the company does well and the stock price rises, the employees make more money. It's one of the reasons that I look at how much stock leadership owns in a company before I invest my own money. And in order to incentivize highly skilled leadership like CEO Anthony Noto himself, or the teams of software engineers they have working for them, they need to pay those people well. Software engineers in particular have been in high demand for the last couple years, with the average engineer's salary up more than 22% than in previous years. And that's not just SoFi, that's the entire market raising the rate for these people. So cutting people's pay in a market where they can leave and immediately get paid more seems like a surefire way to destroy your company. So what's SoFi going to do about this? Well, I think they're going to think long term. In a single quarter, there's not much they can do to drop their stock-based compensation. But over a long time period, let's say a year, they can make it so that as their revenue grows, the percentage spent on issuing shares drops, especially considering they have a large number of performance-based stock units that are maturing from back when they first went public, which aren't going to happen again. Plus, SoFi's chief financial officer told us to expect stock-based compensation as a percentage of revenue to drop in the future. And if you look at SoFi's latest earnings, that's clearly what's happening. In their most recent earnings call, the CFO noted how stock-based compensation as a percentage of revenue was at 16% in Q4 2022, down from 27.5% in the prior same year period. That is a massive drop and puts them on track to achieving single-digit stock-based compensation in the long term. So if this metric is already improving, we then need to focus on a potentially much more dangerous metric for SoFi, one that could actually bring down the entire company into bankruptcy. SoFi's cash flow measures how much money SoFi literally brings in or sends out every quarter. It's one of the simplest ways to measure if a company is making real money, so it's become the gold standard for valuing a company. Heck, Warren Buffett, the greatest investor of all time, even says he uses it before looking at anything else in a stock. And if we take a look at SoFi's cash flow, things don't look great at first glance. In Q3 2022, SoFi's cash flow was negative $2.9 billion, equal to more than half of the company's entire market cap at that time. For someone who's used to looking at tech companies, that seems like SoFi is about to go bankrupt any day now. But the thing about SoFi is it's not just a tech company, it is still a bank, and it's important to look at metrics that are most relevant to other banks. So in SoFi's case, they offer loans, meaning huge amounts of debt get loaded on and off their books every few months, and this can result in huge swings in their amount of cash on hand. These swings are so large that they make using free cash flow basically impossible. They could show $1 billion in free cash flow one quarter and negative $1 billion the next quarter without actually affecting the business. But all we want to know is how much money is SoFi burning each quarter, and how much cash do they have on hand that they can afford to burn through? Well, there's not exactly a direct way to measure that with banks, but we can get close using EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. Basically, it's a form of profit. And if we look at SoFi's EBITDA, it tells a very different story from their free cash flow. SoFi made $143 million in adjusted EBITDA last year. That's $143 million in basically profit for the company. Now, I say basically because the GAAP accounting standard actually subtracts out stock-based compensation from EBITDA, even though stock-based compensation has no impact on SoFi's actual cash. So even though SoFi is still non-profitable from a strict GAAP perspective, they are bringing in more cash than they're burning. And with the company growing at 52% year over year, spending less on stock-based compensation each year as a percentage of revenue, while positioning themselves perfectly for future growth, I don't see any major risk of the company going bankrupt. And more than that, as long as they just continue what they've been doing, the company will more than triple in size in the next 3 years based on their current growth rate. And yet the stock price is below the price they had when they went public. Now, to be fair, SoFi still has risks. The real risk in my eyes is competition. SoFi needs to grow as big as possible to capture as much market share as they can before their competition comes along and copies them. We're in a down market right now, and that hurts. It makes our portfolios look red, but it also makes us want to think like short-term investors, and that's a mistake. I'd much rather SoFi continue to look bad on the surface for a few more quarters and continue to invest in growth than for them to cut back on all their spending, getting lots of praise from armchair stock analysts like me. Look, I'm just throwing my opinion out there onto the internet, but I think our job as investors is to make the best decisions we can with our own money, and I personally am staying invested in SoFi. So if you like this style style of breakdown, or if this is the second or third video you've seen from me, maybe consider subscribing below and sharing with a friend. And if you're looking for something else to watch, here's another video.